Hey, so in this first video, we're gonna talk about how to read a chart and use indicators. So this video is super important because everything about day trading is about reading charts. It's a technical thing. It's not fundamental like long-term investing. We're reading charts. So really important to know how a candlestick looks like and how to use different kind of indicators. So in this presentation, we're gonna touch four main subjects. The first one will be how to read a candlestick. So what is a candlestick? If you're new to trading, you might be confused. Well, we're going to see it together. Then we're going to talk about market structure. What is market structure? We're going to see it in a couple of slides. After that, we're going to jump into trading indicators. So I'm going to share with you all the indicators I use in day trading, and we're going to dive more in depth into each one of those so you can understand how they work. And lastly, we're going to finish this presentation with daily bias. So I'm going to explain to you how I look at the daily chart to have an idea of, okay, if the price, is it going to go up, is it going to go down, or stay neutral? So how I have a bias by looking at the daily chart. So let's jump right into it with how to read a candlestick. So every candlestick is basically telling you a story about the battle in between the buyers and the sellers. So if you can read that story, you'll be able to understand what the market is really doing. So here I put two examples of two different charts on NVDA. The difference is that this chart here is a 1 minute chart and this one here is a daily chart. The difference here is that every candlestick on this chart is represented by 1 minute. So each candlestick is a battle of 1 minute in between the buyers and the sellers. Compared to the other chart here on still NVDA, but this one is daily chart. So every candlestick is worth 1 day. So it takes 1 day to form one candle and is a daily battle in between the buyers and the sellers. So it's the same concept for every time frame you use, whether it's a 1 minute chart, 5 minute chart, 15-minute charts, 60-minute charts, daily chart, weekly chart, monthly chart. It's all the same kind of candlestick. The only thing that changed is the time frame, but the concept we're going to see, you can read it in the same exact way for whatever time frame you're using. So how to read a candlestick? What is a candlestick? A candlestick is telling you basically four information. It's telling you information about the high, the close, the open, and the low of a candle. And basically a candle is giving you two different kind of colors. It's giving you either a green candle, so a green body, or a red body. So if we see a green body like this one here, it means that the price opened right here. It went down all the way here, form a low, and then it zigzag here all the way down, all the way up, to here where it closed. But during that, let's say it was a 1 minute, it pushed all the way to the high here. So that formed a green candle. Where we have a red candle is because the open is lower than the close, as we can see here, compared to the green one where the close is higher than the open. But it's basically the same story. So same four information, the fluctuation in between the high and the low, and you have the open and the close. The way we call those two zones here is we have the body of a candle. So the body is represented in between right here and right here. And those two little lines here is the wicks. So if we look at the chart here, let's say we analyze this first candle here. Let's say it's a 1 minute chart. So what that candle is telling us, that the price opened right here. It went all the way down here, it pushed all the way up here, and it ended up closing right here. So that's the story this candle is telling us. So this is a strong candle because we can see that the close is a lot higher than the open and the body is bigger than the wicks, which is a sign of a bullish candle. If we look at, for example, this candle right here, we can see that the price closed lower than where it opened. So it opened right here, it closed right here. So that's why this candle is red. And we can see that this candle have really small wicks and a really big body. So this is definitely a weak candle where the sellers won the fight. Then if we look at a candle like this one here, really interesting. We can see, yeah, this candle closed white, but it opened here and closed really, really close to where it opened, and the wicks are bigger than the body. So this is what we call an indecision candle. So this is a candle where the fight in between the buyers and the sellers was pretty neutral. So that's basically how you read a candlestick. Really straightforward, but really powerful. It's giving you a lot of information. By the way, if I look at another candle here, just catch my attention, that's another indecision candle. So we can see that the sellers were winning the fight with all those candles here until the fight became neutral. So the buyers didn't want, the sellers didn't want, it just finished equal. And then the trend changed with some bullish candle right here. So that's how I read the candlesticks. Now let's talk about market structure. So market structure is basically a groupment of candlesticks. So when you look at multiple candlesticks together on a chart, they tell you a bigger picture story. So we have the small story with one candlestick that is telling you the fight in between the buyers and the sellers. But by looking at a bunch of candlestick and candlestick patterns, you can understand what is the market structure. So here we're going to see that there's three kinds of market structure. There's either an uptrend, a downtrend, and a consolidation. So the first one, uptrend, pretty straightforward, is when you see the price making higher lows and higher highs. So we can see that the price is moving like this, forming an uptrend. So if we draw the trend, we can see that is a line like this, and we're just slowly going higher. So this is a uptrend. Downtrend, exact same concept, but to the downside. So we're making lower lows and lower highs and slowly moving lower. So if we draw the trend here, we can see that we're slowly zigzagging lower here. And the last one is where we have consolidation. So here we're not making higher lows, we're not making higher highs or lower lows, lower highs. We're just moving sideways. So the price is not really picking a direction, it's just consolidating. So here we can draw down lines of resistance and lines of support. Compared to here is lines of is more like trend lines like this. So pretty straightforward. That's the three kind of market structure you can have on a chart. And again, this you can analyze it either on a 1 minute chart, 5 minute chart, daily chart, weekly chart, monthly chart, any kind of time frame. The same concepts apply. So the most important concept to, in my opinion, to recognize with market structure is the difference in between support and resistance, because that's really, really powerful in day trading. So if we have a trend here, our support is resistance is basically the lines we draw either here or here. And by the way you want to trace those lines, you want to try to take the wicks of all the upper part here and all the lower part here. And by the way, also, what makes a support line or resistance line really, really powerful is when you have multiple touch point. So here we have one touch point, two touch point, three touch point, four touch point. So we can imagine that if the price in the future go back up here, touch that line, it's probably going to reject back down. So that's how you mark a resistance and a support line on a trend kind of market structure. Where we have consolidation, when we have a range, you have the same lines of support and resistance, but that time they're horizontal. But again, same concept. The more touch point you have, the more powerful this line will be. So here we can see that we had some resistance one time here, two time here, three time here, and right here another time. So we can expect that the price will start reject here again. It's never 100%, but that's most often than not how support and resistance line work. The price react pretty good to those. So here we have a resistance, like I said. Here we have our support where we had one touch point here, two touch point. Here we kind of lost it, but we recover it, try it again. So it's not perfect, but we can still see that there were some buying interest here on that support area. So that's how you mark down a line of support and resistance on any kind of time frames. And usually the higher the time frame, like if you mark those lines on a daily chart, a weekly chart, those lines will be more powerful and the price will react a lot harder than if you compare it to a 1 minute chart, for example. Now that you understand how to read a candlestick, how to analyze a chart to know if we're in a downtrend, uptrend, consolidating, let's jump into trading indicators. So I'm going to share with you my 5 best, not even best, my only 5 indicators that I use in day trading. We're going to dive in deep into each and every one of those. And I really consider myself as a kind of trader that likes to keep things really simple. I don't like to have a chart that is too crowded with 10s or 20 indicators. No, I only have 5. I keep it really simple. And that way I can read a chart a lot clearer with less emotions. So the first one we're going to see together is the VWAP. The second one is moving averages. Then we're going to jump into the Carmela pivot points, the opening range, and lastly, fair value gap. So let's jump right into it, starting with the VWAP. The VWAP is an institutional anchor point. So it shows the average price traded and it acts as a dynamic support or resistance. So like we saw, we have a downtrend and we basically have this line, in that case on Tesla, acting as a resistance. The only difference is that this line is following the price, is dynamic. But same concept. If the price was over the VWAP, it will act as a support if the VWAP was like this. But in that case, we can see pretty well that the price open went under the VWAP, resist here. Tried it again, found some resistance. Try again here, found some resistance. So the price is just trending down below the VWAP. It's a mean reversion setup. So the price stretches and then snap back. What I mean by that, I mean that when the price is starting to be far away from the VWAP, usually you're going to see the price going back to retest the VWAP. So pulling back to the VWAP before continuing lower. Then it starts to get really extended from the VWAP. It's going to pull back towards the VWAP before stretches again another leg down. So that's usually what we see. And a little bit later, I think it's the last video of this course where I share my reversal strategy. We're going to see how I like to take my reversal straight really far away from the VWAP for that mean reversion setup. So often we see downtrend under the VWAP and uptrend over the VWAP. There's some situation where you're just going to have, like, let's say the VWAP doing something like this, and you're just going to see the price fluctuate like that in a consolidation. So in those specific scenarios, the VWAP is not really a powerful indicator because it doesn't mean nothing. The price is just trading sideways. But the way I like to trade trends. So when we have a trend, the VWAP act as a really nice support or resistance, depending if we're on an uptrend or a downtrend. So that's pretty much the VWAP. Really easy to set up. The way I have it on my chart is always like a black dotted line like this. So when we trade together in live for that second week, you're going to see at every time I have the VWAP on all of my charts and I always keep an eye on it. The second indicator I want to share with you is moving averages. If you've been into trading for a while, you definitely know what I'm talking about with moving averages. It's probably one of the most popular indicators in terms of either day trading, swing trading, or even long-term investing. It's really common. It's been there for a while. But if you're new to trading, you have no idea what it is, I'm going to go over it really quickly here. It's pretty straightforward, pretty easy to understand. It's basically showing the overall trend. So it's a line that follows the price action and calculate the average of a certain period of time. So every time you add a moving average on your chart, you have the configuration of what is the period you want here? Is it 9 candles, 20 candles, 50 candles, 200 candles? You pick the time frame you want. What I like to have on my charts, I like to have the 9 moving average and the 50 moving average. So I have the red one here and the orange one here, which is the 50. So basically, moving averages act as a dynamic support or resistance. Again, a little bit like the VWAP, it's following the price action. And the smaller the period, the closer it will follow the price. For example, that 9 moving average here is following the price a lot closer than the 50 I have here. Excuse me. So it's great for identifying momentum. And like I said, it acts as support or resistance, so really powerful. As we can see, the 9 here, the price pushed up, went back to retrace towards that 9 moving average and bounce from here. And every time you see the price moving really far away from a moving average, more often than not, it's going to pull back and retest those moving average before continuing in the same direction if we're in a trend, either uptrend or downtrend. So really powerful indicator, really important to keep an eye on it, I believe. Especially useful for me in terms of where I want to take my partials and where I can consider exiting a trade. But in terms of entries, I don't pay too much attention to it. But anyway, I like to keep them on my charts, either for day trading or even for long-term and swing trading. So hope that was clear. That's pretty much how I read moving averages. This next indicator here is an indicator I've been using for about 3 years now. I haven't been using for too long, since the beginning of my trading career. It's called a Camera Pivot Points Filter. Honestly, I love these indicators. I feel like it's really powerful. It gives you a lot of insight. I use it for all of my trading strategies, even to analyze a long-term chart on any kind of time frames. It applies really nicely. So basically, the way you want to read the camera pivot points is between R3 and R4, it's a selling range. And in between S3 and S4, it's a buying range. So let me explain here if you have no idea what is that indicator. So you basically have 4 lines. So you have R4 and R3. R stands for resistance. So we have resistance 4, resistance 3. So 2 resistance line here. That is considered a selling range. So if the price is in between those 2 lines here, we're in a selling range and we have a bigger probability of going back down inside the range. What we have here, S3 and S4, well, it's the opposite. S stands for support. So we have 2 lines of support, support 3 and support 4. And this is the opposite, like I said, so it's a buying range. So if the price is trading in between those 2 lines, there's a good chance that the price will bounce and start going back in the range. And what we have in the middle of S3 and R3 here is what we consider value area. So everything in the middle here, we're just in value. So we either have overextend to the upside, overextend to the downside, or in the middle of a value. So really interesting to read the price action with those camera pivot point. It gives you like a bigger picture of, are we oversold? Are we overbought? Do we have a bigger probability of going back up, of going back down? Do we stand in the middle of a value and we might find some consolidation? Often you're going to see that consolidation, it's going to happen here. Often you're going to see that the trend will start here, moving higher, and then the trend will reverse from here. So if we play reversal, the strategy I'm going to show you a little bit later in that 5-day course, we're going to see that I really like to use those lines as places to short or go long. So I will look to take shorts here, and I will look to take longs right here to catch the inflection point. But that's pretty much the way you want to read the camera pivot points. And one last thing, if you have the price over R4 here, well, here you want to go long. If you have the price under S4 here, you want to go short. So if the price is outside, you want to play the price going outside, so the breakout. So if I draw here, we short, here we long, here we go long, and here we short. Hope that makes sense. So that's the way you read the camera pivot point filter. You can use this indicator on pretty much every platform, I think. TWS, I'm not sure. I know with Dash Trader, the platform I use, and I'm going to share with you a little bit later in this course, you have this indicator. I think you also have it in TradingView. Really powerful indicator that I recommend using, those 4 lines. You're going to see, by the way, when you add that indicator, often you have a bunch of lines. You will have like S3, you will have S4, S5, S6, S2, S1. But I really recommend keeping it simple. Trading should be simple and only keeping 4 lines. You can also add like S6 and R6. But if you don't have too much noise on your charts, if you're new to trading, I really recommend you keep only those 4 lines of 2 support, 2 resistance, and go like that. So that's the camera pivot point indicator. For this next indicator, if you already watched my first strategy video, the opening range break and retest, you know what I'm talking about here. But nonetheless, if you haven't watched the video, this indicator is the most important, I will say, indicator I use for my first strategy that I played, opening range break and retest. And it's basically drawing the distance in between the high and the low of a certain candle. So you can decide to use the opening range of the first 1 minute, like the way I use for my strategy. If you play a different kind of strategy, you can have the opening range of the first 30 minutes, the first 5 minutes of the day. Really depends of what kind of strategy you're using. But it's basically taking and marking a range of the distance in between the high and the low of that specific time frame you're using. Breakouts equal momentum opportunities. So often you will see the price break out of that opening range and start moving higher. So let's say that you have the opening range mark on the first 5 minutes of the day. Maybe the first 5 minutes of the day was choppy, moving like this. So you have your opening range with the range here. And eventually, when the price will break outside of the range of that first 5 minutes, that's where you will have the momentum to the upside. And also, the retest is a high probability entries, and that's what I use, the retest on my strategy. So if we keep the same example here, let's say that was the 5 minute, often you're going to see the price retest the opening range here before bouncing and then making another leg up. So using the opening range is really powerful for that. If we look at the example on MSTR here, I draw the opening range of the first 1 minute candle, so the distance in between the high and the low of the first 1 minute candle. When the price broke out of that area right here, we had a pretty decent push up. So here, a lot of traders, for example, that play the strategy, the 1 minute opening range breakout, they will have entered right here and capitalize on that first move up. The way I play it, I wait for the retest. So I stay patient and wait for the price to come back and retest that opening range, which is what happened right here. So we saw the price decline, retest that opening range, so that line right here, before taking a bounce and moving higher. The difference in between taking the trade on the breakout here versus waiting for the retest is as follow. So when you see the price breaking outside right here for a 1 minute opening range breakout, for example, you're going to see that the move is really quick, but more often than not, that move is not going to be for a long time. So it's going to be a really quick trade that's going to last a couple minutes, like we saw on MSTR here. And even here on MSTR, I consider that breakout took a long time. Often you're going to see like a 1 minute breakout for 1 minute, 2 minutes, and then poof, reverse back down. That happens often. And that's why I wait for the retest. I like that on the retest, when you see a decent bounce from the retest, usually, not always, but more often than not, that will give you the trend for the whole day. Like we saw in MSDR here, the trend really started here, and then we start making higher highs and higher lows and move higher and higher and higher, and until what, 11 here, I have no idea what it did for the rest of the day, but that's a trend for more than an hour. It's really good for my style of trading, actually. Some traders like it quicker, I like it slower, helps me manage my emotions better. But that's the difference in between taking the breakout at the open or waiting for the retest. But pretty straightforward indicator, the opening range. And in most platform, I know on Dash Trader, the one I use, there's an indicator you can put on the chart for opening range, so you don't even need to draw that box manually. Will be drawn for you automatically. You just mark down the time frame you want to have. For me, it's always the 1 minute, and it will be drawn automatically on your charts, and you know exactly where to enter a trade. So this was the opening range. The last indicator I want to share with you is called fair value gap, or FVG. So it's a set of 3 candles with a gap in the middle created by aggressive buying or selling. So the price often returns to fill the gap and use it as a support or resistance. So what I mean by that, there's 2 different kind of fair value gap, either to the upside or to the downside. If we look at the first example on a bullish one here, so we can see that the candle in the middle formed a gap right here in between the first candle and the third candle. So you want to mark down the wick of the high of the first candle here and the wick of the low of the third candle here. And if there's a distance in between those two, like we have represented by the green box here, This is what we call a fair value gap. So this is telling you that there's a lot of strength in the price action. Same example here, but on the opposite direction. So if you draw down basically the wick of the low of the first candle and the wick of the high of the third candle, and if there's a gap in between those two, that's what we call a fair value gap. So this is a really bearish price action. What I mean by the price often returns to fill the gap and use it as a resistance or support. Let's say on the first example here where we have a bullish price action, that the price kept moving higher here and then eventually moved lower inside the gap, and then in the gap here is an area where there's big probability of bouncing and going back higher. If it loses the fair value gap, that's another kind of pattern. If we see the price moving higher here, going back down and going under the fair value gap, that means that we filled the gap, and then there's a bigger probability that we're going to start moving lower. So this is a kind of engulfing here. So really important to pay attention to fair value gaps. I use it for my two strategy for the reversal. Really important. I need to see a fair value gap. We're going to see it a little bit later in the course. And also I keep an eye on it for my opening range break and retest strategy. But pretty straightforward. It's something that you're going to see and realize just by looking at candlestick patterns where the fair value gaps are forming, and either if it's a sign of strength or a sign of weaknesses. Now I want to see with you an example of actual trade that I took, and I want to talk with you about all of those indicators that we saw together and all the concept we saw with candlestick and market structure, and how when you apply all of those together on a chart, it gives you opportunity to take some really quality and high probability setup. So this was a trade I took on Tesla. We can see that I entered to the long side right here using, if you watch my opening range break and retest strategy, this was a strategy I utilized for this trade, and I catch the move all the way up here. So the first indicator we saw together was the VWAP. So we can see that the VWAP is the black dotted line on the chart here. So we know that the VWAP is a kind of indicator that follows the price action, and usually when the price is over the VWAP will act as a support. So we can see that the price pushed over the VWAP, so I know that the VWAP will now act as a support. And then the price pull back down, touch the VWAP, bounce from here, touch it again, and bounce again. So I know I'm on the right side of the trade, and I have confidence because the VWAP is supporting the bias I have with that trade. Then second indicator we talked about was moving averages. So we can see that this red line on the chart I have here is the 9 moving average. Same concept as the VWAP, the price is over it, so it's acting as a support. As we saw right here, it bounces from here. So here I was having a lot of confidence because I was having the VWAP plus the 9 moving average acting as support. Then the third indicator we saw is the Camarilla pivot points. So I have R4 here, R3 here. We don't see S3 and S4 on that trade. It was probably lower on the chart somewhere here. But we remember that resistance 4 and resistance 3 is a selling range. So we have a big probability in between those two lines to go back down. But we also saw that when the price is over, so outside of the range, over R4, it's acting that way as a support. So I know that the price, when it went over R4 here, if it goes back down to retest R4, R4 will also act as a strong support. So here, if we think about it, we were having the 9 moving average, the VWAP plus R4 acting as strong support. So I have a lot of confidence on that trade. And talking about support, we were having another one here with that other indicator we talked about, the opening range. So the distance in between the high and the low of the first 1 minute candle. So this box was drawn automatically on my chart, and it corresponds really nicely with the VWAP, with R4, and with the 9 moving average. So when I saw the price pulling back to retest that opening range, that's where I took the trade, exactly on the opening range. And the last indicator we saw together is fair value gap. So as we saw, a fair value gap is formed with a pattern of 3 candlesticks. So we had the first candlestick here, second candlestick here, and third candlestick here. And we can see that the distance in between the high of the first candlestick and the low of the third candlestick, there's a gap in the middle here. So that's what we call a fair value gap. And often we see the price pushing outside of the fair value gap, then back inside to retest it. And inside the fair value gap, that's where you find some support. So the support here will be like a zone, draw right here inside the gap. So basically with the VWAP, the moving average, the camera pivot point, plus the fair value gap, that's 4 indicators giving me support at the exact same spot. So seeing that, I enter with a lot of conviction here and really heavy on that trade to catch a beautiful move up. And that's the power of indicators. When you match all of those together, it's really strong. If I were just having one, I would have been as much confident on that trade as I was seeing everything lined up here. So that's basically how you read a chart using all the indicators. So that's the way I use it. I hope that it was pretty clear for you and you understand all of those indicators. And that's how I read a chart.